Welcome, guys.
Hello, good morning.
Come on in.
I'm gonna put the intro video in the chat too.
I see some new names. I see some familiar names. You guys are going to learn today how to earn some tax-free money. Nothing better than tax-free money, right, Jose?
And tax-free money, long-term wealth planning.
All sounds good to me. That's all music to my ears.
All good stuff.
Guys, make sure that you're checking the chat. Good morning, Stephen. Good morning, Andrea. Make sure you guys are checking the chat. There are some links in there to some YouTube videos for you guys to take a look at after today. There's some additional resources.
And I did invite a lot of my clients, so we're gonna have probably a bigger crowd today, I'm assuming.
Good morning.
Oh, there's Kash.
There's our special guest.
Good morning.
How you guys doing?
Good, how you doing?
Hey,
There's Kash. We're just letting people in. We just started.
The doors have opened. Everybody's taking their seat, getting that last cup of coffee. You know, you got the coffee and water station in the corner of the room. Come on in, guys. Get settled.
Good morning. Good
We'll
morning.
be starting here in a minute or two. See, my friend Dwayne's here as well. Haven't seen him for a while.
Dwayne, I actually texted him last night. I asked him to come.
Yeah, nice.
He was going to. It would have been good for him to be here. We have Ron also. I talked to Ron yesterday. Invited him.
Good. For those of you just joining, you can go into the chat and there are some links in there to some YouTube channels, some resources for you guys that are also from Kash. It's from his YouTube channel, some videos that he's put out, some education for you guys. So we'll continue to put those links in, throughout. Just make sure you guys are checking the chat as well.
Yep, I put on there my Instagram as well. Follow me on Instagram. I do a lot of tax tips on there on my stories. Follow Kash as well.
Yeah, I love Jose's Instagram because it's either straight business and tax and like educating you on stuff and what you need to do, or he's on vacation somewhere. So he's living the life. He shows you that once you apply those tax strategies, then you make extra money, you can go on vacation.
It goes to show that the planning works.
Yep.
Life.
And here these guys are in suits and jackets. I'm in a t-shirt and a hat. This is
you're a real estate guy. It's okay.
Well, I got properties I got to go look at today, so it's going to be hot as hell outside. And most of these properties don't have air conditioning because they're vacant and abandoned. So I had to throw the old hat on today.
Yeah.
So true.
We make money.
It's hot out there.
Well, we're going to go ahead and get started, guys. So welcome, everyone. I'm glad that everyone was able to join us this morning. We are the Broward and Miami-Dade Real Estate Investors Association. And the reason why we are hosting this event and sort of co-hosting it with one of our favorite corporate members, Jose Ramirez, Chief Tax Strategist, owner of Advanced Tax Advisors. He's been, Jose has been a corporate member of ours, has been educating our members and our students, has been doing tax strategies and investment strategies and forming corporations and things for our company for years. Jose handles all of my new corporations, and we've been talking about some new strategies and some buy and hold stuff that I'm going to be doing and getting into in real estate. We've always appreciated, our alignment with Jose, and he's not just somebody that we do business with. He's also a personal friend of ours. So if you guys do not know Jose Ramirez, without any further ado, let me turn it over to Jose so he can tell you a little bit about himself, and then he'll introduce our special guest for today as well. Really quickly though, make sure guys that you put your questions in the Q&A. This is going to be, obviously it's live. This is going to be interactive today. So put your questions in the Q&A. If you put them in the chat, it's like a group text message. It gets populated so quickly that we're going to miss your questions. So just make sure you put those all in the Q&A. So Jose, tell them a little bit about yourself.
Excellent. Thank you for the intro, Ryan. So Jose Ramirez, some of you already know me. Some of my clients are here. So I'm the tax advisor that helps you save you tons in taxes, right? Real estate investor as well, which is why Ryan and I connected many years ago, and we've been helping him save thousands in taxes for many years. So today we're going to do something a little different. Normally we talk about tax planning strategies, but today I'm bringing a good friend of mine, Kash Rastan. He is a wealth advisor and a wealth coach nationally. He was nominated by USA Today, third top wealth coach in the nation. So he's pretty up there when it comes to wealth management and creating strategies to retire with a nice income, right? So he's also the executive producer of Think and Grow Rich, The Legacy, the movie. He is just an amazing person. I've been working with him for the past year now, and the strategies that we've implemented together have worked phenomenally. So I'm going to turn it over to Kash Rastan. There you go, my man.
All right. Thank you, Jose, for having me on. I'm fired up and excited. So let's go through this. Here's the thing. So my promise to you is that today you're going to learn a lot of stuff. So that's fair. Hopefully you're raising your hand. But the thing is, we're going to go over through a lot of stuff. So you probably need to take some good notes. And so I'm going to give you a little agenda what we're going to go over. I'll tell you a little bit about the state of the industry, what's going on right now with Corona, all that kind of stuff. Then we're going to get into it. Jose will kind of go over a little of the basics of finances. Then we're going to talk about some tax strategies when it comes to investment. And then on the back end, we're going to tie in everything into real estate. So I want you guys to know everything is going to be real estate based today, how to maximize your investments and then get it back into the market. We're going to talk about what does B of A, Wells Fargo, USA, all of these big banks, what do they do? Where do they keep their money? How do they use such a things like private placements and hold their assets in there, and they turn it back around and invest it in real estate? So that's kind of what we're going to talk about today. But we're going to start with some basics and getting into it. But before into it, let me give you a little background, because I'm actually originally from Iran, and I came to US in 1999, and I didn't speak a word of English. So if you said hello to me, I pretty much give you 2 thumbs up. I got to tell you this background because usually somebody was talking about money, usually they're in their 60s, got some gray hair, not somebody's from Iran in their 30s. So when I came here, I didn't speak any English. So I worked in car washes. I worked in gas stations. I didn't have any confidence at all. I was kind of the shy kid. And, everybody said, hey, if you want to go, you want to become successful, you got to go to school. So that's what I did. I learned English, and I went to USC, University of Southern California, and I became a civil engineer. So I was kind of good with numbers. I became an engineer, started working as an engineer for a couple of years. But then, as many of you guys know, that's why you're in real estate. I found out the corporate route wasn't really the right way to become really wealthy. So I said, you know what? I got to start a business. Long story short, I ran into 2 people. They're talking to each other about some class about money. I didn't know anything about money. And the only thing I learned about money at USC was how to open up credit cards and get a free slice of pizza, right? So I figured everybody in America knows this stuff beside me. So I went talk to this one guy, and he said, hey, we have this class if you wanted to come into. So I ended up going to this class, just learning about money. And next thing you know, I met a mentor of mine who eventually introduced me to a guy named Ed Milet. I don't know how many of you guys ever heard of Ed. Ed is one of the top 50 wealthiest people in the world. So I started learning a lot of these principles from him and learning how to not just apply this stuff to my life, but actually build a business around this. And, and everything changed. I started applying this stuff. When I started, I was just an engineer making 60-some thousand bucks a year. And I had a car that was 55,000. And when I sat down with the mentor of mine, he's like, hey, Kash, how much you paying for this car? And I told him how much I was paying. And he's like, Kash, if you would invest just your car payment, that would be like a couple $1,000,000 in 30 years from now. And I said, what, really? So I started getting rid of all my stuff. I started investing about $500 a month. Then I got it to $1,000 a month. But then as I learned these principles, which I'm going to share with you here today, I started investing more and more and more. I learned how to build a business. I built a financial services business. By the time I was 33 years old, we had 4 locations and 6 locations. We had about 400 licensed advisors that worked with us, and I was making 7 figures. And I got to the point where I was investing $40,000 a month. And by the time I was 33 years old, I was completely retired. I invest a few $1,000,000, and the interest on those money was paying all my expenses. And I was making 7-figure residually from my businesses, real estate, all the stuff that I was doing. So I was like, what's next? So I started a foundation, which is my passion. This is why I still do this. It's called All for One, where we basically build orphanages around the world. And let me kind of share this with you just so you guys kind of see some pictures right here. This was me when I was working in Subway. So look at that guy right there.
Many years ago.
I would get some financial advice from that guy. Not really, but anyway. So, and this is our foundation, All for One. We have 20 places now around the world. And through learning this stuff and through my mentor, he then introduced me to a guy named Tony Robbins. And I started learning a lot of stuff from Tony and different people. And this is the guy I was mentioning, Ed Milet. If you don't follow him on social media. He's a big time real estate investor, and I started learning a lot of this stuff from him. Okay. So that's a little bit about me. That's enough about me. Let's get into like what's going on right now. And this is right. I'm going to give you some stats. This is pre-pandemic. I'll go through this fast, as you guys know a lot of this, but look at this. It says 44% of Americans don't have enough cash to cover a $400 emergency. This is pre-corona, everybody. Now look at that one. 43% of student loan borrowers are not paying paying their payments. This is, again, pre-corona. Look at that one. 38% of the U.S. households have credit card debt. This is my favorite. It says 33% of American adults have $0 saved for retirement. Furthermore, 56% of American adults have less than $10,000 saved. So if you look at half of the United States, you guys, has less than $10,000 saved. So if nothing else, I'm assuming that's not you. So we got to be grateful for what we have for sure. Now, I know you guys know this. If you look at that at the bottom, it says Social Security Trust Fund is on track to be depleted by 2034. Some basic stats. Now look at the financial education in the United States. There's only 5 states in the United States that requires financial education. 45 states require sex education. So that kind of tells you what our priorities are. And you guys, this is a challenge. Why am I showing you this? Because I was talking to this gentleman. Let me kind of give you an idea on this. So I was talking to this gentleman, and we were talking about the situation right now in Afghanistan. And this guy was talking about the fact that he was a Marine. And when he was in Afghanistan, and one of the Afghani guys saved his life and killed 2 people that were about to kill him. And he didn't even know this guy. So he goes up to him and says, hey, why did you do that? He's like, because you're a guest in my country. And they're like, you don't even know me, and they say, it doesn't matter. So they started getting to know each other. And the Afghani guy turns around and tells him, he's like, look, you don't even know anything about our culture. And he's like, what do you mean? Well, I want to know. He's like, you know what? The Afghani mans can never go to war without a permission from their mother. So if their mother does not give him permission, they can never go into a war. So the Marine guy says, are you telling me right now that all of these guys, these Taliban's, they got permission from their mom to go do what they do. He's like, yes, exactly. It's like, well, what's the difference between your mom and their mom? It's like, because my mom learned how to read, and their moms are not allowed to learn. And this is why Taliban goes in there and basically gets rid of all the schools for girls and burn the schools for girls. And why am I telling you this? Because the craziest thing is, if you can not empower people and not give them the education, this is how you can get full control of people. And I'm telling you right now, there's a massive thing when it comes in the United States, and this is why I'm so passionate about this, where banks, investment firms, insurance companies, literally all of these companies, they understand that if people are not educated about this stuff, they can make a lot more money. And this is why I'm so passionate about this. Right. So anyway, look at how much student debt. There is $1.45 trillion. Now, here's a little bit of stats on the financial companies. As you can see, Goldman Sachs requires $10 million investment for them to manage somebody's money. And on their basic stuff, like the more lowest level, just to manage some money, they need $1 million. And now if I go in there and invest that $1 million, guess what? I can't take that money and put it in real estate because it's been invested. So I'm going to show you how you can do both. How you can have your real estate and grow your assets as well. A little bit about our industry again. This is Merrill Lynch to their sales rep. It says we must put a limit on the amount of charity work that we do, or we'll not have the time to service and grow the base of our customers, willing to able to pay for quality advice. If they're FCs, financial counselors, that really enjoy servicing small accounts, please let me know, and I will get you a nice salary job in investor services group where you can deal with poor people in your heart's content. And I'm just telling you this because that is a financial services industry for you in one literally paragraph right there.
Isn't that crazy, guys? That's pretty.
Yeah, just crazy. All right, let's get into our education. So I'm going to turn it around. And by the way, this is last year. Let me give you one thing on last year. A lot of you guys know this. 35% of all US dollars was printed last year. So you want to talk about inflation, you want to talk about knowing your game around money. It's been more important than ever right now. So this is why this stuff matters so much. This is why I'm so passionate about it. But we want to start with the basics. You know, when you want to build wealth, it doesn't matter real estate, doesn't matter anything else. There's three basic principles that you got to cover, which Jose is going to cover with you. It's kind of like if you want to become healthy, you got to do three basic simple things. If I ask all 80 of you guys right now, what's the three things somebody got to do to become healthy? What do you tell me? You got to eat right, you got to exercise, and you got to rest. You don't have to be a doctor, and it's very simple. Not easy, but simple. We all know we got to exercise, but doing it is a whole different game, right? So there's three basic principles when it comes to building wealth. So Jose is going to go over that. But before that, one thing you got to know is something's called the FIN number, financial independence number, which is the total amount of money you need to have that the interest on that money and your rental properties combined together will take care of all your expenses for the rest of your life. That it's having clarity on exactly where you want to go. If you're golfing, as long as you know where the hole is, you can eventually get the ball in there, even if it takes you 3 days. But imagine if they blindfold you and you don't know where you're going. Chances are you're going to end up somewhere else. So that being said, let's cover those three basics. Jose, I'm going to turn it to you. You take it over right here.
Okay.
Your screen, or I can go for you, and then I'll come back on and go into details of this.
I was going to do the Roth IRA part. I mean, I can do this.
I'll go over this, and then you go that part. That's fine.
Okay, that's fine.
So let's talk about this. This is the FIN number that I talk about. We got to become very clear on exactly how much we need. Then we got to figure out how much we got to put aside, how much real estate assets needs to have, and got to have a combination of both, because the best world is where you have both, and I'm going to show you how. And then you got to make sure you never run out of money, and you got to make sure it gets transferred to all your kids tax-free, which we're going to talk about today. We're going to talk about state taxes with the E. Okay, I get my S's and E's mixed up. So we're going to talk about how you get rid of estate taxes. A lot of you guys know, once you go over $10 million of threshold with all your assets over $10 million, doesn't matter how many states, how many trusts you have, any of that stuff, Then there's a 40% state tax. Biden right now proposed a tax proposal to take the $10 million tax exemption to $3.5 million tax exemption. So, which means if you're worth $10 million, okay, if this law goes in, that means that anything above $3.5 million, so on the $6.5 million, there's going to be a 40% state tax that you must pay. There's no way around it. There's one way, which I'm going to show you today. So now, again, I know a lot of you guys know this. This is the basics of money, and I want to go into the detailed stuff and how you use this stuff to invest in real estate. So the first principle is Rule of 72. Albert Einstein called this the eighth wonder of the world. And it says, if you take number 72, and if you divide it by the interest rate that you get, that will give you the number of years that it takes for your money to double. How many guys heard this one before? Hopefully all of you guys. So if let's say somebody's getting 1% interest rate, as you can see there, if somebody's getting 1%, what's 72 divided by 1? It's 72. It takes them 72 years to double their money. That means, let me just see if I can write on here. Will be better if I can write on here. So I take number 72 right here, divided by 1 is 72. It means if somebody's 29, they got 10,000, 72 years later, they got 20. If they get 4%, their money now doubles every 18 years. So 29 to 47, 10 goes to 20, then it goes to 40, which sucks, we all know. Now, if I get 6%, now in the same exact period of time, 10 becomes 20, then becomes 40, then it becomes 80. So the key to pay attention here, though, the reason I'm sharing this with you, because you got to look at when you give 2% more, this is the importance of 2%. So remember this, we're going to talk about this on the back end. You're going to double your money as long as you're getting 2% more. So as long as you remember this point later on when I come in and relate this to real estate, okay? Now, if I get 10%, I double my money every 7.2 years. So look at this, from 29 to 65, same exact period of time, one time $10,000 become $320,000. Everybody with me?
Big difference.
So, guess what the bank does? The bank takes our money, don't give us any return. They take it here. They invest it in different assets, stocks, real estate, things like this, and lend it to people, make 10%. I'm going to show you where the banks exactly keeps this money, okay? Today, I'm going to go to FDIC, Federal Depository Insurance Corporation. I'm going to go into their balance sheets, and I'm going to show you where they keep this and how you could do this as well, meanwhile investing in real estate. So now, let's go to, so that's the first principle. Second principle, very important, not losing money. Warren Buffett said, rule number 1, don't lose money. And rule number 2 is never forget rule number 1. So when you're investing long-term, see, some people go into fixed assets. Some people go to the stock market. They do one of these things. And some people go to an indexing strategy. We're going to talk about indexing strategy today. Indexing strategy is where we use something like an S&P 500, which is Apple, Google, Facebook, Tesla, where you can use an S&P 500, but when the stock market loses, you don't lose. But when the stock market goes up, you can get up to 15% of the market. So if the stock market does 30%, we can get 15%. If the stock market loses 15%, we don't lose anything. Meanwhile, we're going to have access to that money to invest and buy different assets and do bonus depreciations and so on. So the reason this is a big deal is because if I have $100,000 and if I lose 50%, how much do I have? I have $50,000. Now, a lot of times people think, well, I lost 50 and I got 50, but if you lose 50 and you get 50, how much you end up with? 75. So here's the thing. If you lost 50, you actually need to get 100% to catch up and go break even. So this is why this is such a big important factor. Now, let's talk about the biggest killer of wealth. The biggest killer of wealth, as all of you guys know, is taxes, okay? Taxes. So taxes are biggest killer of wealth, and we're going to show you how you protect yourself. I'll give you an example. So there's tax now. where we pay taxes every single year on our investment, such as where we have mutual funds, exchange traded funds, things like this. And then there's tax laters, which is such a things like 401ks and IRAs, where they give us, when we put our money in there, let's say we put $5,000, we don't pay any taxes going in, but when that 5 becomes 50, guess what we have to do? We have to pay taxes on the entire amount. Okay? And then you got your tax exempt, like your Roth accounts, where you already paid your taxes on your investments. So if you put $5,000 in, you already paid taxes on that 5. So when that 5 becomes 50, on that 45 we just made, we do not pay taxes. Okay? And that's very basic stuff, but it's very important to understand this. So obviously, which one's the best one? So what if I could invest my money here and then turn around and invest in real estate as well? So that's what we're going to talk about today. Okay. Now, to kind of give you guys a perspective on the numbers. So let me kind of show you a tax now. And here. All right. So I just got your comments. So let me go here. Let me show you these tax differences. So if I were to go on Google and go on a compound interest calculator and share this screen with you guys. Here, let me see if you guys can see this screen. Now we're going to go over some numbers. Okay. I hope you're ready. Okay. If you're washing dishes, this won't really work. So if I go compound, so let's do compound interest calculator. Okay. So let's look at this. See, if I have $100,000 right now, okay, and I invest for, let's say, 1 year and I get 10% return, Ryan, on this, how much money do I have? 110,000. Simple math. Yes. Ryan, I'll play with you since I can see you. Now, if I, Ryan, on this 110,000, if I have 100,000, make 10%, I make this. Now what do I have to pay on this 10,000 I just made? Taxes, right? Uncle Sam, my favorite uncle in the whole world, says, hey, Ryan, pay up your fair share. Now, if I have mutual funds, exchange traded funds, they're going to be trading inside of those mutual funds. So whether I sell or I don't sell, I still got to pay the taxes on this thing. So let's just say I only pay 20% on this. So then what that means is I have 108,000. Everybody with me? Mm-hmm. Which means I didn't really get 10%. I really got 8%. Okay. So when you look at the effect of this long term on our investments, so let's look at this now in a 30-year period of time. So if I have 100,000 invested 30 years, that 100,000 will end up being 1.7 million. That's if I don't have to pay taxes on it. However, if every single year I have to pay 20% taxes, which means I got 8%, I end up with $1 million.
Big difference, huh?
It cost me $700,000 because I was in a taxable account in something called managed accounts. There's a lot of tax liabilities there, but the reason people go managed accounts, brokerage accounts, because of the liquidity of it. So I'm going to talk about how you can have liquidity and avoid paying the taxes. So that's going to be our talk here today. So you see the big difference in this. Now, if I have an 401k, for example, on the back end, I got to or IRAs, I got to pay taxes on this on the back end of my investment. So, which we're going to get a little bit deeper on this. So when I have a 401k, by the way, I want to get all the matching that they give me. Okay. I'm going to get all that matching. But above that, we want to go into our tax exempt categories, which we're going to talk about here today. Now, I'm going to get very deep in taxes in a little bit, and I'm going to show you why this is a crazy thing, because a lot of people think later on I'll be in a lower tax bracket. We're going to talk about why that's not the case for a lot of people. So we'll get into a little bit more detail as far as that stuff goes. But let me kind of go back into my presentation here. All right, here we go. So now, before this, let's talk about our financial services industry. I want to talk about a little bit about financial services industry because this is very important if you have financial planners or financial advisors. the financial advising industry is driven by quota. This is what everybody doesn't know. Everybody thinks, well, it's what licenses somebody has, whether they're fiduciary or not fiduciary. I'm telling you, it doesn't matter if the person it is fiduciary, not fiduciary. What matters the most, and nobody tells you this, is what is the quota of the company. So let me give you an example. Okay, very important because a lot of you guys have financial advisor and rely on them, and they're good people, all of that stuff. But what matters the most is what is the quota of that company based off of. So I'll give you an example. Wirehouses such as Wells Fargo Advisors, Merrill Lynch, Chase, Wells Fargo, Morgan Stanley, UBS, Goldman Sachs. These companies, their quota is based on something called money under management. They charge 1% to manage the money. So, and they mainly work with people who have a lot of money, because if I'm charging 1%, it's not worth it for me to work with somebody who got 100,000. 1% of 100,000 is very little. They don't work with those guys. So what they talk about all the time is money under management, which I do got to pay those 20% taxes on it. Okay. So now, then you got your second category, which is more like New York Life, MetLife, Northwestern, Mass Mutual, Woodland Reed. These financial companies, their quota is based on life insurance, based on whole life policies and annuities. Okay. So what they push is whole life and annuities. So both of these guys could have all their licenses, be fiduciaries, but what matters is where the quota is coming from. You guys with me? So the challenge in our industry is people go based on trust instead of learning this stuff on their own. And if my cousin works at Merrill versus if my cousin works at Northwestern and I trust my cousin, so I go to my cousin and say, cousin, what should I do? And the cousin says, hey, you should have, let's just say, a whole life policy or whatever it is they say. But the problem is, see, if you go to a Toyota dealership, you can't get, and your cousin works at the Toyota dealerships, you can't get mad at your cousin because he works at Toyota dealership. You went to the Toyota dealership. It's your fault. You went to Toyota dealership. It's not the cousin. So it's very important to understand. This is not to knock anything down. It's just to understand where the whole thing works. Then you got the Primericas of the world. You got the Dave Ramseys and the Susie Ormans of the world, where they talk to the masses, like the churches, where they say, buy term and invest the difference. Buy term, invest the difference. Then you got your independent advisors like AXA and LPL and Edward Jones and TFA. Now, these companies, they can do either one of those three categories. However, nobody starts here in this fourth category. They start in category 1, 2, or 3, then they transition to the category 4, because that's where the new blood comes in through those other 4 industries in the financial services industry. It's kind of like religion, okay? 90% of the religions in the world are based on where you were born. If you were born in Middle East, you most probably are Muslim, okay? So it really, that's a very important factor to understand. So I only share this thing with you guys because this is why it pays to understand this stuff, because all the advice that we could be getting from our advisors, it's related to this. All right, now that I told you this, all right, let's go to, let's talk about basics of investing, okay? I'm gonna go over this a little bit faster because I don't need to talk about this basic stuff. So let's talk about the 3 basic things people invest money in. So they either put their money in stocks, they put them in real estate or bonds. Now, this is simple. I always try to keep this simple. Albert Einstein said, genius is making something complicated simple. So when you look at stock, it's very simple. Stock just means what? Ownership in a company. Ryan has a company. Ryan wants to expand his company. He comes to me and says, Cash, give me $10,000 and I'll give you one piece of my company. So I give $10,000 to Ryan. Ryan takes one piece of his company. He gives it to me. Now I own 1% of his company. If his company makes profit, I make profit. And if his company loses, I participate in the loss. That's it. That's what a stock is. Owning a company. Real estate, everybody's experts on that. Then you got your bonds. What is a bond in its simplest form? Bond simply means a loan. Same scenario with Ryan. Ryan has a company. He wants to expand his company. He doesn't want to give Cash any ownership. He says, Cash, lend me $10,000. I'll pay you your money back in 5 years plus some interest. That simply is called a bond or a loan, which I can get from a private company, or I can go to the government, to the US government, and I can get that loan from the US government. Okay. That simply got stock real estate bonds. Now, here's what happens. So then what they do is, I'm gonna skip this professional money management thing because for the sake of time. So then what they do, here's what they do, okay? Because I think this is too basic. So you got your stocks. So here's very important to understand the history of these mutual funds and exchange traded funds. So what the word mutual fund is, as all of you guys know, is the word mutual means bunch of. So Wall Street comes in and says, you know what we're going to do? We're going to take a bunch of these stocks and bunch of these bonds, and we're going to bundle them together, and we're going to create something called the mutual funds or exchange traded funds. That's all that is. So all it is, it diversifies it. So imagine if I have a stock is just, it's one cable that's holding me. So let's just say I invest in Coca-Cola. There's a chemical in Coca-Cola that causes cancer. What happens? Boom, right? That's what happens. That's what happened to GE a few years ago because of the pension problems that they had. Now, if I have a mutual fund or I have exchange traded funds, I'm diversifying. So if something happens to Coca-Cola, I still got Pepsi. Pepsi goes up, okay? So I don't lose all my assets. Now, sounds great, right? Now, watch this. I'm going to talk about where the challenge comes in with this, okay? So first of all, let's have a little better understanding on this. So then the Wall Street takes these mutual funds and exchange traded funds and they package them and they put them in different things. So for example, they put them inside 401ks. So what is a 401k? Actually, let me ask you this. Why is it called a 401k, not a 205, not a 205k? Very simple, because it's just called 401k is just a tax code.
The tax code, right.
401k is not an investment. It's just a tax code. It just pays, you don't pay tax now, you pay tax later. But so what's inside a 401k? What's the engine? The engines are these mutual funds and exchange traded funds. Now, when somebody gets an IRA, typically, what's the engine? Mutual funds and exchange traded funds. Somebody can have an insurance policy. Inside of it, they have mutual funds and exchange traded funds. Somebody could have a Roth IRA. Inside of it, they have mutual fund, exchange traded funds, or stocks, okay? Typically what most people do. So reason I show you this, because a lot of times people ask us and say, hey, Kash, which one has a better return, 401k or IRA? Which, as you can see here, would be an ignorant question because 401k has no return, nor IRA has a return. It's these funds inside of them that give us the return, okay? All right, so let's get into it a little bit deeper now. In US today, there are 27,000 mutual funds and exchange traded funds that exist, 27,000. Why are there 27,000 of these things? So Fidelity got a couple hundred, Vanguard got a few hundred, PIMCO got a few hundred, and so on. So what happens so Wall Street saw an opportunity in basically late 70s, early 80s, where the 401k industry was introduced, when people went from pension, because everybody before then had pension, nobody invested money in mutual funds, they had pensions. Now then 401k got created. They saw an opportunity where they can make money from people in these mutual funds, okay? So if you see some people who has an advisor, majority of the time they have some stocks, bonds, and they have a bunch of mutual funds and exchange traded funds. As you guys probably seen this. Now, when I talk to people, here's very important to understand. I'm going to get a little bit deeper now. So when I talk to people and people say, yeah, I've done pretty well. And I'm like, why? It's like, man, I really like my advisor. I'm like, why? Because he's like, well, I got 15%. They look at their statement. It says 15%. They're like, great. My market's up. My advisor is pretty good. Now, here's the thing. If you got 15%, but the stock market did 20% return, guess what? Your advisor sucks, okay? Now, then I talk to people and people are like, oh man, my advisor sucks. I'm like, why? He goes, oh, because he lost me 10%. I could have done it on my own. Well, I'm like, well, if the stock market lost 20, but your advisor lost you 10, well, he's an amazing guy. So you got to compare it to the market. because we got to compare this to the US stock market, which is pure in its basic form for the sake of right now, is S&P 500. What is S&P 500? The 500 biggest companies in US, Apple, Google, Facebook, Tesla, and so on, okay? So we want to see how we doing to the market. Are we outperforming the market or are we doing less than the market? That's how we look at something. We're like, are they doing good? Are they not doing good? Now, here's the news. 96%, there's two things we got to talk about. 96% of all funds, mutual funds, Vanguard, Fidelity, doesn't matter what the fee is, doesn't matter any of that stuff, okay? 96% of them, they don't outperform a basic S&P 500. So you guys probably heard this story. Warren Buffett went to Wall Street, talked to all the hedge funds and the mutual fund money managers, said, look, if any of you guys can outperform S&P 500, I will personally pay you $1 million. And if you don't, you got to pay my charity $1 million. Now, I'm sure by now you know who won that bet. So if I go right here on Google, and if I look this up, and if I look at Warren Buffett, $1 million bet, as you can see right here, you can see it says Warren Buffett beat the hedge funds. Warren Buffett just officially won his $1 million bet, right? And so on. So anyway, you can see that, you know, he won that bet, which I can basically share with you guys a video, but for the sake of time right now, there's a whole video on it. You can just go to YouTube and see it. We're not going to go over it. Okay. All right. Let's go back to what we were talking about here. Where did my presentation go? It wasn't any of these. Let's go back here. I'm going to bring it up. So here we go. This is where we were. We were on this slide right here. So that's one big challenge. Okay. One big challenge is 96% of them don't outperform. Now, let me see if you can guess this. There's another big challenge with all this IRAs, 401ks, money management stuff. Now, when you look at somebody's 401k, okay, I'll just say this for the knowledge purposes. What do you think, if you were to guess right now, what do you think is the percentage of the assets in there that goes to the fees inside the 401k? If anybody can put a guess right here, I would like to see if you can. I don't know if they can put it on the chat, Ryan, but if they could, I would like to see if somebody were to guess it, okay? And okay, by the way, Alberto, that's a great question on that property that you sell. I'm going to talk about how you can avoid that $350,000 in taxes. So stay with me and I'll tell you exactly in detail. Now, watch this. I'm going to share my screen again. Let me go back. If I go to Google and if I look at compound, because I got to tell you all of this stuff before I tell you, because you know the whole picture. If I look at this, somebody said 9%. It's actually 1.5%. So all the management fees inside of a 401k on a good one comes down to be about 1.5%. And there are many fees inside of a 401k. I'm not talking about the fund fee. There's basically 8 different fees inside of a 401. They only show one of it. Now, let's say I invest for 30 years and I invest $500 a month into my 401 or IRA, whatever I'm doing, and I get 10% return. And I pay 1.5% fee. I want to show you this just so you get an idea. The effect that that fee will have on my assets is $275,000. Let me just let that sink in.
Yeah, it's big. 1.5.
9 out of 10 people who have 401k, they think it's a free service that their company offers. Where else do you go in the United States where you pay for something for $275,000? You don't even know you paid for it. The only place that it happens is in the financial services industry. Okay. This is why I'm so passionate about this, because I told you about the education of it. So, because we can save all of that money and invest it back into real estate, that's what our topic is going to be here today. So let's get into it a little bit deeper then. All right, Kash, I'm with you. I'm with myself. Here we go. So I can show you a bunch of these videos and all sorts of different stuff on these things on 401k. Can you hear this?
Yes. Frontline.
Let me share. Let me see if I can skip this. I don't need to tell you why there's so many fees, right? Just go look up the fees inside 401ks, and it will be a whole 60-minute did a video on it. Times Magazine, all of this stuff. There's a whole thing in this in the financial services industry, and what we're going to talk about is how to avoid all of this stuff, and at the same time have liquidity and be able to go into real estate. Okay, how can we have it all? Can I have it all? That's basically the idea behind this. Okay, all right. So for sake of time, because I want to leave a lot of time for Q&A to get into the good part of this. So let's go here first. Let's go here, right here. Let's go. So let's look at these different assets that we got right here. So taxable assets, we got, our checking, savings, CDs, stocks, bonds, mutual funds, exchange traded funds. All of this stuff are taxables. Tax deferreds are my 401ks, 403bs, which is same thing as 401 for teachers, IRAs, SEP IRAs for self-employed. Majority of people in real estate, they have a SEP IRA, simple IRA, TSPs, and these are the basic things that we got in tax deferred. And then you got your Roth IRAs in tax exempt. You got your private placements and VULs on your tax exempt side. So now we want to talk about something called a backdoor Roth. So and how we can take that money, invest it, and then move it to a backdoor Roth, and then take that money and invest it in real estate. That's one topic we're going to cover, which Jose is going to talk about that. And then we're going to talk about private placement as well. Okay. So those two things we're going to talk about. Then we're going to come back on the back end, how to protect yourself from state taxes. So Jose, you want to take it? You want to talk about this section for a second?
Yeah. So the Roth IRA, a lot of you guys are familiar with the Roth IRA. Great job, by the way. You're doing amazing. High energy. I love it. So for those who qualify for the Roth IRA, there's some income limitations, right? So if you're making $200,000 or more a year and you're finally married, you're not going to be able to qualify for the Roth IRA. The threshold is different if you're single. I believe this year is like around 132 to 140. So there's a way around it. You can do a backdoor IRA. What you do is you contribute to your traditional IRA, and it's not a deductible IRA. You can't deduct the contributions, but then you turn around and you call your Vanguard, your Fidelity. You say, hey, I want to convert this to a Roth IRA now that I contributed my $6,000 to my traditional IRA. They convert it, and you get a tax form at the end of the year saying that you contributed to your traditional, and then you converted it, so you don't get a deduction for the contribution. And now that money becomes Roth IRA money, which the growth grows over the years, tax-free, right? That's the benefit of the Roth. The Roth is great because, and something we're going to talk about later is the fact that the taxes are at the lowest they have been in a long time, right, Kash? So we want to mention that it's a good time. It's a good idea to put money away post-tax now, because where do you think taxes are going to go? They're going to go up, right? It's already happening.
Yeah, that's a big one.
So we got to talk about that. You'll talk about that too. But so if you qualify for the Roth, by all means, max it out. The 6,000, max it out, because that growth over 30 years, by the time you retire, is going to become hundreds of thousands or even millions. All right. So that's one way. The backdoor IRA or the conversion of the IRA. All right. That's all I have.
Okay, cool. So let's go taxes. Okay. Let's talk about taxes when we're talking about tax later. And why don't we because a lot of times people, like most people, right? Jose, they go to their CPA and CPA says, hey, just put your money in a 401, put your money in a pension, you're deferring the tax. That is correct, but you're just kicking the can down the road. Okay, you're not permanently solving the problem. That's why this is a big deal. So
can I add to that?
Yes.
Because I've actually given that advice. So as a tax advisor, I will tell you, let's set up a 401k, put some money away. But ideally, what you want to put away is up to your employer's match, right? Because the rest is just you're kind of just wasting it, right? Put it up to your employer's match, because that's free money that you're getting from the employer. Everything else can go into other vehicles that we're going to talk about that now. So we're not completely saying that the 401ks are horrible.
Yep,
they're
exactly.
super horrible. No, I'm just kidding. They're not horrible. They serve a purpose.
Absolutely.
To a certain level, right?
Absolutely. So let's talk about something. Here it goes. So you ready? My favorite topic. So when I talk to people, I say, look, let me ask you a simple question. Do you think taxes are going to go up or going to go down? So half the people say up. Half of them says, well, it depends who's in office. And, and then some of them just really don't know. Okay. I go, I don't know. So we want to talk about this because this will affect you massively. This is what the topic of taxes is something you want to get really educated on. So let's look at the history of taxes for a second. So let's look at the tax history. So here we go. This is the history of taxes, okay, where the taxes were. So I'm going to see if I can write on here. So if you look at the taxes, where we have been, I want you to watch this. So right here, if you look at it, right here, this period of time, you guys see this? This is basically the 60s, 70s, and 80s. I want you to understand this. The tax bracket were 70% in the United States. Why do I show you this? Because people say, well, it can't really go any higher than what it is now. Well, it was at 70%. Hello? Then Reagan came in, brought Reaganomics on his first term, brought it down. Second term, brought it down. And right now we're right here. This is actually when Trump came in and then brought it right here. It's like to finish, this is like right around here. So right now we're actually in some of the lowest tax bracket we've ever been. Okay. So this is important because here's understand the history of, because once you get to understand the history, you see why the certain advices are given out to people. So when you look at this period of time, this is where the 401ks and IRAs came into place. So originally when 401ks came out, it was only meant to be for presidents and vice president of companies. It was never meant to be for employees. So these people were making a lot of money. They were in a high tax bracket. So the idea was, hey, I'm going to defer the tax to a later time. Hopefully later time, I'll be in a lower tax bracket because it can't go any higher. That was kind of like the idea. Okay. Okay. That was the idea back then, which was correct. Okay. But now that idea is not true for majority of people anymore. Okay. Why? Because sometimes people are like, well, when I retire, I'm not working, so I'm going to be in a lower tax bracket. Well, even if you're not working, if you have real estate properties, you have income. If you have Social Security, that's considered income. You're going to pay taxes on it. If you're taking money out of your IRAs or SEP IRAs, if you take 100 grand, it means you worked and you made 100,000. So when I talk to people, I say, look, do you want to have the same lifestyle or would you want to lower it and go to live in North Dakota? You know, most people, I live in Newport Beach, so nobody wants to go to North Dakota. I'm sure somebody's from here on the call in North Dakota. But most people are like, no, I don't want to do that. So that's the idea is if you want to have the same lifestyle, most of the time you're going to end up in the same tax bracket. I'm going to talk about this. But what happened here, this idea came in that I'm going to defer my taxes to a later time. And then these guys taught it to their kids, and then they taught it to their kids. I don't know if you guys ever heard that ham story. There was this little girl. He sees his mom. His mom is cooking a ham. And as mom is cooking the ham, the mom is cutting this side of the ham and this side of the ham, then putting the ham in the oven. Okay. And then the kid goes, Mom, why are you cutting this side and cutting this side, then putting it in? It's like, I don't know, because my mom did it. So they call the mom. They're like, hey, why'd you cut this side and cut this side? And she says, I don't know, because my mom did it. They call her. She's still alive. And they're like, hey, she's 100-some years old. She's like, hey, why'd you cut this side and cut this side? She's like, because, my pan was too small. So I cut this side and cut this side and put it in the oven. Okay. But then that stayed as a recipe in their whole generations. And this whole idea that I've been a lower tax bracket has something like that in effect. So you see the history. Now, this is the highest tax bracket. What if we looked at every tax category? Okay, let's look at every tax category that exists. Okay, let's look at this. Look at history of tax bracket. If I look at the 25% tax bracket in 2013, it was 25. If I go back from 2013 to 2000, same tax category paid 28. If I go from 2000 to 1987, the same tax category paid 35%. If I go from 1987 to 1980, same category paid 43%. So that is true for every tax category, what we're talking about. Everybody with me? Hope you're with me on this.
Yep.
Now, there's also something called a marginal tax bracket, which I am sure all of you guys are familiar with. But just in case there's maybe one or two person that is not familiar with this concept, we also have to understand the marginal tax bracket. So if I go again on Google and I look up federal tax brackets, I like money chimps. So if I go on federal tax brackets and come right here, I can look at my tax brackets if I'm filing jointly. Okay, so I got to understand tax bracket. So between 0 to 19, I pay 10, 19 to 80, I pay 12, 80 to 171, I pay 22.
Mm-hmm.
So one of the questions I always ask people, I say, Leg, hey, so-and-so, let me ask you a question. If you make $81,000 a year, how much taxes are you going to pay? As a matter of fact, let me ask you guys, if somebody is making 81,000, how much taxes do you guys think that person pays? Everybody says 22%. A lot of people say 22%, not everybody. But we all know that it's not correct. I only pay 22% on that $750 that's above the $80,000 that I'm going to pay $700 on that $750. I pay 22. But for this portion, I always pay 10%, even if I make $1 million a year. And for this portion, I always pay 12%, even if I make $1 million a year. Does that make sense, everybody? So, in other words, even if I go from making 171,000 to 80,000, so if I live on half of what I live now, and I don't know why anybody would want to do that, okay, living in America, the idea is when you retire, you will hopefully have more money. But even if you were going to live on half of what you earn, you're still in the same tax bracket. And there's no tax savings there for majority of the people. So first, understand this principle. But I'm going to talk about how you double dip, okay? We're going to talk about double dipping today. So, and that's what the bank does. So we're going to show you what the bank does it, okay? How do I not pay taxes on the growth of it and not pay the tax on that property I just sold right now, okay? So we'll talk about that in a second. But I want you guys to really understand. I was an engineer, so I kind of need everybody to understand. I feel sometimes the need to explain everything to everybody. So all right, let's go back. So now we understand this principle. Now, here's another challenge, okay? The challenge is our Social Security and our Medicare system. So in America, when Social Security and Medicare got started, okay, when this got started, you would get your Social Security at 62 years old when they started originally. The problem was the average life expectancy was 59. So people died at 59, Social Security started at 62. Then the people start living longer and longer and longer and longer. Okay, you see the problem? So when originally Social Security and Medicare were started, for every 50 people that paid into the program, there were only one person taking money out. Today, for every one person taking money out of Social Security, Medicare, Medi-Cal, there are only 3 people that are paying into the program. And that's why there's a challenge. Now, where is the money for Social Security, Medicare, Medi-Cal comes from? Hello? Taxes, okay? Nobody wants to talk about this. At least nobody who's running for the office. But there's a guy named David Walker. He's the Comptroller General of the United States. He's a friend of mine. I had him at one of my events. He was basically the CFO for the country, and he had a few thousand people working for him. And he's like, Cash, taxes will never be lower than what we are right now. And you can just go watch on 60 Minutes. There's an interview on him, David Walker. He made a movie with Warren Buffett called IOUSA. He goes very deep in this topic. But I keep it simple. I like to keep simple. So if I'm talking to Ryan, I just ask a simple question. I say, Ryan, if I lend you money right now, Ryan, what's the first question you should ask me? Let me ask you guys. If I were to lend you money, what's the first question? And most people say, well,
Terms,
how
right? What are the terms?
the interest rate? And I say, don't worry about the interest rate. Why you worry about interest rate? Take the money, go enjoy it, have a blast. When you come back, I tell you how much I would charge you. Would you ever sign up for that deal? What's the answer? The answer is no, right? I would assuming no, right? That's
Hopefully
what
not, right?
IRA says. Hey, put your money in a 401. You don't worry about it now. We'll tell you how much we charge you. So what I'm trying to tell you is just deferring it to a later time. It does not solve our problem. Okay. So let's put our focus in tax exempt. Let's get into detail. Let's talk about Roth and private placements, and then how we take that money and we're going to go back in and invest in real estate. Okay. And get a lot more tax savings right now. So here we go. I don't want this one. Are you seeing my screen? Let me see. I want the other one. Here we go. All right, here we go. Let's go here. All right, so let's go here. So let's look at a simple investments, and I'm going to cover some numbers now, and I'm going to talk about something called a private placement. Okay, it's called a private placement insurance. Okay, and it's not a typical life insurance. I don't like putting money inside life insurance, so stay with me on this. Okay, I'm going to talk about some numbers. I'm going to give you numbers, and I'm going to take you to tax savings. And once you see the numbers, if you're a number guy, you're going to be like, this is genius. Okay. All right. So let's look at taxable, tax deferred, tax exempt. I'm going to take $500 of money and I'm going to invest this $500. Why $500? Because I'm going to put it in S&P 500. Makes it simple. Let's say I put $500 into the stock market and I'm going to spread it between Google, Facebook, Tesla, all the 500 biggest companies in the United States. I'm going to invest it between these. Why do I put in S&P 500? Because it outperforms 96% of all money managers, all financial advisors, all mutual funds, and all exchange traded funds. 96% get outperformed by an S&P 500. So I'm just going to go to S&P 500, pay no fee. And I told you those lessons. I don't want to pay fee, and I want to outperform the market. So we're going to use S&P 500. I'm going to use $500 in a taxable, tax deferred, tax exempt. Why 500? Because we can multiply it by 10, and then we look at 5,000, 10,000, 100,000, $1 million doesn't really matter. Okay. Because as long as you understand the number for 500, you will understand the number for $1 million. So if I take a $500 investment and it's a $500 I pay taxes on already, it's my own $500. I paid the taxes. I'm investing it for the sake of right now, just so we're equal in all three categories. So if I put $500 in the taxable, 10%, 30 years, if I don't pay no taxes at all, I'm supposed to end up with 1.14 million. However, if I have to stop and pay the taxes every year, remember I showed you that example early on when I showed you $100,000 at a 10%, we'll end up with 1.7. But if I only get 8, I end up with 1 million. And because I have to pay taxes, this is that same example. Because I pay taxes on it, I only end up with 690. That's a big difference, you guys. Okay. Now, let's go here. So there's a $450,000 difference, by the way, on the first one. Okay. Now, if I go to my 401ks and my IRAs, I put $500. First thing that happens, I get a tax write-off. Correct. I get a tax write-off. I can reinvest that money. I have more money right now. Correct. But let's look at this. What happens though, I defer my tax to a later time. On the back end, I do pay taxes on that money. Okay. So I go to my tax exempt. So I want to go to a backdoor Roth IRA, which means I open up a 401k, I max fund it, and then I change my 401k to a Roth IRA. And then I can take that money and I can be it self-directed. I can put it in real estate, do anything like that with it. Or I'm going to use private placement insurance. So life insurance has been tax-free for generations. Okay. But nobody ever cared. Why? Because they only gave very little return. And anytime I wanted to take my money, they charge me, they will give me a loan and they charge me a lot of money. And there's a whole industry around this, which they created these things like whole life policies and universal life policies and things like this. What I'm talking about is none of that stuff. I'm going to show you what the bank does. But just so you understand what these things are, you got your regular term insurance, and then you got your whole life. This is what Northwestern, New York Life, MetLife, and all these companies offers. And with these policies, the way it works, if I were to write on this here for you, the way these policies work, so let's say I have $500,000 worth of life insurance. They take my cash value and they give me dividends. In other words, if New York Life makes profit, they take their profit portion of it and they share it with their policyholders. They give them 3 to 5%, maybe 6% at best to their what? Policyholders. Okay, great. I have a life insurance policy and so on. Great. Now, here's the challenge. Anytime I want to borrow money from this, I got to pay. There's a loan and I got to pay a percentage. I got to pay 4% to 8% loan fee on this, my own money when I'm borrowing it. So why would I ever want to do that? Even though it's tax-free, there's a rule. I'll have you guys go check it out. Just like a 401k, here's the rule. It's called IRC 7702. 7702. A lot of you guys might have heard of it. IRC 7702. Now, IRC 7702 says in the US tax code, it says I can borrow money from my insurance and not pay taxes. Okay, great. But who cares if I have to pay 4 to 8%? Okay. That is basically what's called a whole life policy. Now, let's get a little bit deeper now. Then they created this thing called a universal life insurance policy. Just like a whole life, the only difference is, there's a couple of differences. One, the major difference is that they give you a fixed account. They give you a fixed return. They don't give you dividends. You might get 3%, 4% fixed guaranteed. The other difference that it has, whole life, you must pay your payments. Universal says, hey, 1 month you put in, 1 month you don't put money. It's flexible. The word universal, just like universal wrenches, it has flexibility, okay? So this is called universal life insurance policy. Then in the early 90s, they said, okay, let's create something called a variable universal life policy, where they said, okay, we can take this investment and now invest it into the stock market. Why don't we just take this cash, put it into the S&P, put it into the stock market. And here's what they did in the late 90s. They said, what if we create a loan called a wash loan, where I can take a loan out of my policy at a 0% interest rate? All right, great. That's awesome. Okay. But still, I have exposure to the market, which means the banks, B of A, is not going to lend me money against my policy for my real estate, which I'm going to get into in a second. Okay. I'm almost there. Okay. And I'm going to go into the B of A, and I'm going to show you what B of A does and what Wells Fargo does, okay? I think it will be a big surprise for you guys when you see it. So here goes. Let's go back to our numbers. So I got my Roth and I got my private placements here. You know, Roth got these rules, and you can't really touch it until 59 and a half. You can take the money, invest it in real estate, but you cannot take it out of the Roth. Otherwise, there's a 10% penalty. Private placement, they have a surrender period. 5 years, I can touch 50% of my money. 10 years, I can touch 100%, unless I max fund it, that's what we're going to talk about, which in the second year, I can have access to half of my money. In 5 years, I can have access to 90% of it. But what I'm going to show you right now is how I can have access to all my money very fast, almost immediately. Okay. So stay with me on this. Roth has limitation as far as how much we can put in, 6,000 maximum. Private placement don't have that limit. That's why it's called a rich man's Roth. Okay. It doesn't have income limitation. Now, inside of a Roth, I'm in the stock market. Stock market does 20, I get 20. Stock market loses negative 20, I get negative 20. Private placement companies, insurance companies, have an ability to pull risk. What that means is they can allow us to do indexing. What that means is I can go to the S&P 500, pay no fee. If the stock market goes down, I don't lose anything. And if the stock market goes up, I can get up to 15% of the stock market. And you're going to see in a second why this strategy actually outperforms S&P 500. I'm going to show you the numbers. So if the market does 20, I get 15. If the market does negative 20, I don't lose anything. Okay. So that's that. Now watch the numbers. Okay. Let's talk about this. Let's say I have a life insurance policy. Okay. And let's say I don't give a crap about life insurance for a second. I have $100,000 life insurance policy, which means if I die, somebody else, my estate, my kids get $100,000. I could care or not care. Okay. Leave that alone. All that is, it's a protection. That's all it is. It's a protection against taxes. It's a protection against lawsuits. And it's a protection against the loss of the market. That's all we're using the insurance. I don't want to lose money. I don't want to pay taxes. I don't want anybody to sue me and take my money. That's why I'm going there. Now, inside this insurance, there's two things. There's the cost of life insurance because I got to pay for that insurance. And then there's our investment bucket. Now, watch this. So let's say the cost of a life insurance policy is $50. $50 a month goes to my life insurance, okay? Just like car insurance, same thing. Now, if I put $100 into my policy, well, $50 goes to my cost, and then $50 goes to my investment. Well, where does this investment go? Like I said, S&P 500. Market loses, I don't lose. Market goes up, I get up to 15% of it. Now, let's say I come in and max fund my insurance, okay? What that means is I put the maximum allowable by the IRS, okay? And that depends on the size of my policy. The bigger my policy, the more money I can put in. So I come in and put $550. So guess what happens? My cost stays the same. Guess how much goes to my saving? $500. Now, if I goes $500 to my saving, I can get the same 10%, same 30 years, boom, and pay no taxes on it. So now I got $1.4 million and I don't have to pay taxes. Now, watch this now. If I take that $50 and I double it, let's just say it's $100. Why? Why do I do that? Just to prove a point, it really doesn't matter what the cost of insurance is, because that's where everybody gets stuck at, okay? Let's say it's $100. And if I take that $100 and I multiply it by 12, it means 12 months, I pay $1,200 in a year. If I multiply that by 30 years, guess how much I paid? $36,000 I paid for life insurance. But let me ask you a simple question so far. I haven't showed you double dipping. This is just one dip, okay? I'll show you the second dip in a second, okay? The first dip is, would you rather pay $36,000 on life insurance costs? Or let's just say it this way. Would you rather put $36,000 in a trash can, okay? Or would you rather pay $230,000 to $450,000 on taxes? Which one? Let me go back.
I'll buy the trash can any day.
Any day, right? So watch. So if I go here, let me highlight this just so you guys can see this. The question is, would I rather pay $36,000 in cost of life insurance or $230,000 to $450,000 in taxes? Obviously, the answer is what? I would rather pay for the insurance. Now, here's the thing. Watch this now. This $450 goes to who? Uncle Sam. This $230 goes to who? Uncle Sam. This $36,000, who does it go to? You know what most people say? Well, it went to the life insurance company. That's only correct temporarily. Because what is the mortality rate in America today? In other words, what percentage of people in America die? 100%, right? So guess what happens to this $36,000? It comes back on the back end as form of a life insurance to my states and to my kids. So in other words, that I didn't really pay for life insurance. The life insurance company got that money, used it meanwhile when I'm alive and made money on it. But on the back end, it goes to my kids and pays for my state taxes. Okay. Everybody with me right now? Hopefully you are. Okay. So let's talk about a couple of things. I'm going to show you how this outperformed the market. I'm going to go right here. I'm going to get deep now. So stay with me. Stay with me because we're about to get deep.
Put it on the chat if you guys are following this, because this is pretty powerful. What Kash is doing right now is showing you how the life insurance can actually save you hundreds of thousands in taxes while growing your, your balance in your account.
Yeah, and not life insurance, because we don't really care about life insurance. Okay, I mean we do. I mean,
well, the cost portion of it, right? Yeah, we don't care about the life insurance, but having that component attached to your investment account is what's saving you the tax.
I got to give you the final punch. Okay, you're gonna see it in a second. The question is, what type of life insurance? Private placement life insurance policy. Okay, we're gonna talk about this in a second. But let's look at the S&P. I want you guys to see this. So if you look at the S&P 500, I just want you to see the numbers because this will blow your mind. If I look at S&P 500, okay, I'm right here. Okay, S&P 500. That's at 1990. If I go back 1996, 1997, 1998, 1999, it did 19%, 31%, 26%, and 19%. So if I had 100,000, my 100,000 will go to 236. Let's say I went to the S&P 500 and I only had a cap of 13.75. What that means is the market did 19, I got 13. Market did 31, I got 13.75. Did 26, 37.5. Then 13.75, which means my $100,000 only grew to 167. Everybody with me? But I didn't lose any money. Now watch. When the market goes down, but whatever goes up must come down. Okay, when it goes down, this 236 goes to 141. Okay, be ready for it because it's about to come. So here, I didn't lose anything. I'm at 171. Now you fast forward this strategy, everybody. Look at this. When I look at this now. When I fast forward the strategy, in the S&P 500, by the end of 2019, I was at 518. And in here, I was at 685,000. So we're not talking about just a strategy that is just more secure, but it's more secure and it does better than the market without paying any taxes on it, okay? So now that we know this, let's look at a couple of things. How many guys know Tony Robbins? And I met Tony through my mentor, Ed. And Ed actually helped Tony to write this book. He went and interviewed Warren Buffett, Ray Dalio, all these guys. Here's what I'm talking about, called Money Master the Game. And if you read this, let me just highlight this for you because you probably see it a little bit better. If I highlight this, Tony talks about here something called a rich man's Roth. It says this strategy in pages ahead, known as private placement life insurance policy, PPLI, has been called the secret of the affluent by New York Times, and for good reasons. It talks about unlimited deposit amounts, no tax on the growth of your investments, no tax when it's accessed, and any money left for your kids is also tax-free. Okay, now we're getting this. And let me show you how the banks use this for a second. Then I'm going to show you how we're going to use it in real estate because I haven't given you the puncher yet. I'm going to show you the double dipping in a second. Somebody asked a question, how do I sell a property, don't pay tax? We're going to talk about that in a second, okay? So if I go right here and let's say, so you can go and you can look this up. For the sake of right now, I'll just show you this video. So if I go, and you can go to FDIC, when I talk to people, I say, look, let me ask you a question. Do you think banks keep more money? And I got to share my sound here so you guys can hear the sound of this. Do you think banks keep more money inside insurance?
And in order,
do you think banks keep more money in real estate? Okay, watch this now. Then you're going to see how we're going to use this money to buy real estate. So watch this. This is FDIC's websites. And as you can see right here, it says assets and liabilities. This is public information. Go check it out.
In order to do so, we thought it'd be a good idea to take a look at the balance sheets of two of the biggest banks in America. And although the name's going to stay grayed out, what I can tell you is this is a very patriotic bank. And the definition of a balance sheet is assets and liabilities, what the bank owns and what it owes. And just cutting to the chase, if we scroll down to line 41, what you can see is they have life insurance, but they call it an asset. And the number associated with that asset is pretty substantial. It looks to be about 21 million, a little bit over. But actually, if we scroll back up, what we can see is the title of that column is dollar figures and thousands, meaning we need to add a comma and 3 zeros to that number. So it's actually over $21 billion in life insurance assets. Now we'll find a much more popular asset class, real estate, on lines 10 and 11 on this balance sheet. So if we look at bank premises and fixed assets, other real estate owned, it totals a little over $9 billion. So why, you ask, does life insurance make up more than double how much the bank owns in real estate?
Okay, so you guys saw that, okay, and you can go check it out. And it shows you all sorts of different banks in the back end, but we don't have the time. Now, here's also what, if you look at all the wealthiest people, what they do, if you look at that, like I just brought up one of them. I think I have one of them right here. So if you look at, like this is GE. If you look at, for example, any company, Fortune 500 companies, and if you look at the CEOs of the Fortune 500 companies and you look at their annual report, you can also see that all of these guys do same exact thing for their executives, okay? and then I'm going to talk about real estate. So I'm hurrying up to get there because we're almost there on our time thing. Because I'm going to show you the kicker here. So if you look at this, it will show you how much these guys are getting paid. So this guy, for example, this guy, Jeff Emmett, he's the CEO. He gets paid $3.8 million, $4 million in bonuses, and you can see the rest of these guys. Now, if you look at this, you can see how much money they put into different things. As you can see, they put whatever the company matches, which is $9,275, they put into their retirement saving plans, but they put $445,000 a year into the insurance policy. And you can kind of see it's the same scenario with all of these guys. So it's a very simple strategy that the bank use and the investment companies use. There's so many different books. There's a great book called Power of Zero, and how you get yourself to the zero tax bracket. But now let me show you this, okay? Now here's what we do, okay? Watch this now. Okay, now I'm about to get serious now, okay? So I use a private placement policy, okay, PPLI. I can put however much money I want to, doesn't matter. I can put $1 million into it. Let's say I put 200,000, 200,000, 200,000, 200,000, 200,000. So I'm putting 200K a year into it. It could be $2,000 a year, okay? I'm just giving this as an example. It really doesn't matter. So at any point, and remember, this is a floor of 0.75, and it has a cap of 15%. So a few things are happening. One thing that's happening, number one, I'm not losing money, okay? Number two, so number one, I'm not losing, right? Number two, I'm not paying taxes on this. Because I'm not losing any money, and because I don't have to pay taxes on this, this is a secured asset to a bank. And by the way, I can take money out of this anytime I want to at a 0% loan for myself. But why would I ever do that if I can get 15% return on here? Because I can go to a bank, okay? And a bank, because this policy is a secured asset, okay? It's a secured asset. In other words, I will never lose money on it. So the bank will say, I'll put a lien on your policy, but I will lend you the money that you have inside your policy. I will lend it. You can get a loan. So for the sake of this example, let's say I got $1 million in there, okay? It could be 100,000, could be 10,000, doesn't matter. Then I will go to B of A and I say, B of A, give me a loan. So they say, okay, you have $1 million? Okay, great. I'll give you up to 90% of this, up to $900,000 of this. I'm going to give you a loan. What's the loan rate? Prime -1. So right now it would be about, let's just say 2.5% to 3%. They give me a loan. Now, why does this matter? Because my money is still invested in the market. Okay, so watch how I'm double dipping. I'm going to get it to it. So let's say right here, I'm getting 10% return on my money on average. So if I'm getting 10% and I'm paying 2.5%, what am I really netting? I'm getting 7.5% on $1 million, which is what? That's 75 grand a year that I'm making on my money. But watch this. Remember they talk about, I don't want to pay taxes. So I take this loan and then I take this money and then I invest it in real estate. Then I go do what's something called a bonus depreciation. When I do, and I go to, let's say, for example, what I do in whatever investment I want to do, whether it's some investment property that I want to buy, whether it's a group's syndicate thing that I want to do. And so you do cost segregation, which I'm sure you guys see in the class on that, where you do a cost segregation. You've done the class on that, right, Jose?
Oh, yeah, of course.
The cost segregation. And right now, and this expires in what?
2025.
2025.
We got a couple years left to use that strategy. Yeah.
So then I'll take that money and I invest it back into whatever or real estate. And then what I can do if I'm considered a real estate professional, which Jose can talk about that and how you could do that, or you can have your spouse be that person. So then what you can do, you can take all that basically as a loss really against, in other words, you can bring the depreciation against your income. Not just the money you make in real estate, but your income. So if you made $1 million, you take that million, you invest it, and you can get that You
So
can
just
get Yeah.
to tie it all together, Cash, I just want to kind of like
Go ahead.
quick summary on this. So because a lot of us are real estate investors, you guys are real estate investors and qualify for the real estate professional status. And a lot of you guys do landlording, which reduces your taxable income, tax liability, sometimes to zero. Let's just say it's 10%, right? So 0 to 10%. All the money that you're making on the yearly basis, now, if you put it into a vehicle like this, it's going to grow without having to pay the taxes up front because you are in real estate, right? You're reducing your tax liability via the real estate, and the growth is tax-free if you place the money in this vehicle. Make sense? Now, the double dipping comes with the example that Cash said about lending money, the bank's lending you money on this asset that you have. So think of the policy or the vehicle as another piece of real estate. You're going to the bank and saying, hey, bank, I got this secured asset here. Why don't you lend me money on it at 2.5%, 3%, while it's still growing at 15%, whatever the rate of return is for you that year. So you're getting growth on your growth. You're compounding on compounding, which is pretty amazing, right? Make sense? Put in the chat if that makes sense.
So now we're double dipping, but there's a triple dip, okay? Let's talk about the triple dip on the back end, because if you are a real estate investor, there is estate taxes that we got to pay, okay? I'll give you an example. For example, one of my clients here. So if I have assets in anything, real estate, anything else, is the last thing I'll show you, a couple of things I'll show you. So if I go in here, for example, and this is a study that we can do. So if somebody just currently worth $6 million, that's all they got, $6 million worth of properties or whatever. And we only look at this, and the person is 45 years old. This is one of my clients, and they have all these assets in real estate. And that's $6 million at 40, they're 45, their wife is 42. Just letting it grow at 5%, that's going to be $47 million. And even if the state taxes laws don't change, what's his tax liability? $8.4 million. Even if he paid taxes, everything, if we put it in a trust, what comes in handy is that death benefit of a life insurance, because eventually we can put that into an irrevocable life insurance trust, and that comes out of your state and can pay the taxes. Now, this becomes a massive issue, okay, if the tax laws go into action right now. And then we'll do a quick Q&A. Let me see if I have the tax laws that they're proposing. So here's a kind of a quick summary on these tax laws that are being proposed. So look at this: capital gain taxes from 20% to 40% for anybody who's over $1 million in income. But look at this one. This is the state tax exemption. Okay, this is the big one that I was talking about. So if you look at the estate tax exemption, currently is $10 million. Okay, the proposal is to decrease the estate tax exemption to $3.5 million with a top tax rate of 45%. So what that means, okay, is even if you have a $2 million, okay, so let's look at the math on this. Let's say you have an asset and it's only $2 million. So we're not talking about massive, giant.
See, there's a war. Properties you're already at 3 million.
Yeah, the reality of it is there's a war on wealth. Okay, so even if $2 million is nothing. Okay, so if I got $2 million, okay, and let's say I am 45 years old. So, and I'm going to live until 85. Okay. So that's 40 years of growth. Okay. 40 years of growth. And so right there, and that thing is 0. And I'm only growing it at 5%. We're not talking about something crazy. That's $14 million. So if I got $14 million, I'm going to finish this because we got 1 minute right on time. Good job, Cash and Jose. You guys are so good when it comes to your timing. Still got 60 seconds. So if I got $2 million and this 2 million became $14 million. So on that $14 million, the proposal is let's take $3.5 million off of it. On the rest of this, I didn't do it the right way. 14, 1, 2, 3, 1, 2, 3, minus 3.5. So 1, 2, is it, did I do it right? Okay, yep. So now I got on that 10 million. Proposal is 45% state tax. How much taxes are due? 4.7 million. How long? 9 months. Can I avoid that? Using a private placement strategy. That's just one of the things, by the way, we do. So, and it's not, by the way, we own no products. Okay. We work with PAC and Nationwide and Prudential and John Hack. We do credit repair and we do mortgage. We do all of this stuff. So we actually, this is just one piece of what we do, but specifically Jose wanted me to talk about this, and we have classes on all this stuff, by the way, just so you guys know, every Saturday from 10 a.m. to 12, it's a free class, 10 a.m. to 12 o'clock on different topics. One topic could be a private placement, one could be credit, one could be mortgage, one could be a tax, one could be life insurance, one could be college planning, and one could be money management, one could be annuities, all of these different topics. I just talked about one thing and one thing alone. So that being said, we're right on time. And thank
Excellent,
you.
Kash. Awesome job. Excellent. I love
was
everything.
Excellent.
And you guys wanted to get more info, you can follow up with Jose. I'm sure he can put his calendar link. And if you guys want to know deep, how do I do this? If I already have a policy, it can be immediately changed at no problem to the new policies, by the way.
Yeah, that's fine. Even if you already have policies, you want to look at them.
You just set up a time with Jose, like a 20 minutes consultation. We just tell you, okay, it's very important to understand we do not have quotas. We don't have any of this stuff. We're just like Amazon in finance. We believe in giving values. And if we give a lot of values, people come to us anyway. Okay, that's our ideology. And because we can make money on so many different things, we don't care really what people do. So you can, Jose, put your link there. They can set it up, and then we could do Q&A.
It's on there. Okay, excellent. So if you guys are interested in learning more and you want to put some money away, you can schedule an appointment with me. We'll talk about what it's like to work with us and take it from there. Anything you want to add?
Awesome. So if you were an attendee of this webinar, you actually are going to get a special discount from Advanced Tax Advisors. Look out for the thank you email on that. I know we're a little bit past time, but this is such great information. I know a lot of you will be willing to stay on a little bit longer. So if you are, stick with us. We're going to be answering your questions. If not, and you have to go, you only scheduled until 12:30, no worries. Come to our YouTube channel and you'll be able to see the replay of the entire webinar. So if you have to go and you missed the last 5 to 10 minutes of answering questions, come back and watch the replay and you'll be able to get whatever you missed. So thank you for those who stuck with us. And we're gonna get into the Q&A. So Jose, Kash, Jose, would you like to ask Kash the questions? How would you like to do this?
Yeah, let me bring these up. Hold on, let's see here.
Perfect.
Any questions? And somebody asked about the classes. We just basically need to have your information and then send you the Zoom link. If you just connect Jose or me, or just message me on Instagram or message Jose on Instagram, and then we'll send you the link on it. I'll put my Instagram here again and Jose's Instagram. Jose, if you want to put your Instagram there, they can message you, email you. I'm the best with Instagram. Jose is the best for email, just so you guys know. If you email me, you might not hear from me for a week. But Instagram.
Emails is okay. I get so many emails that sometimes I miss them. So Instagram or call, basically.
Yeah. So if you want to ask me any questions, Jose, or if you see the question here, I can actually see the question.
Can you see the questions? I'm going to bring it up.
All right. So Alberto, I think we answered your question as far as that on what to do on it. You can get it back invested. You get all those taxes right off. How do I get my money from a 403B and a self-directed SEP into my Roth? Very simple. It's called basically it's just a rollover. We can sit down with you and show you how to take it from 403Bs and SEP into a Roth. That's a very simple thing. What type of life insurance? Private placement. Difference between private. Oh, great question. What's the difference between private placement, life insurance policy, and IULs? They're very similar, Eduardo. The difference is how they designed. Okay. They're very similar, but the difference is how they designed. So they get their smallest insurance policy. They put the maximum amount of money in there. And then when the person's done putting money in, the design is set up that it cuts the life insurance if they want to. Okay, so basically there's no cost on the very little cost on the back end of it. So that's the difference. Okay, is this investment on the radar of the government? Because yes, it is. That was if you just check up David Walker, it is absolutely is.
So are Roth Ira as well, Roth IRAs.
The thing about insurance is, you guys, just so you know, is grandfathered in. So once you have it, they can't do anything about it. That's number one. Number two is that a lot of the people in the Senate use these strategies. So it would be a hard law to pass when I was looking into it. Okay. What are the risks that's unknown to consider? So for example, some of the risk is, let's say, if you have that money, but let's say you don't have a good credit, the interest rate that you probably get probably will be higher. You never want to cancel your life insurance policy because they have a surrender period, so you got to pay a penalty. You always lower your policy. You can go from $10 million to $100,000, but you just don't cancel your policy, because if you do cancel, then you lose your protection. Great question.
Yeah.
Are there drawbacks? I just kind of went through the drawbacks of them because they have a surrender period. And another thing is, you do got to qualify for it. That's the catch. Okay. But there's obviously ways we could do it, through a spouse and different things.
Yep.
Does a private placement provide? There's few of them that are very good, like PAC is pretty good, Nationwide, and Allianz, and some of these are good, but it really depends on your age and your situation, where we need to do a study on it. So we can show you the numbers. Just set up a time with Jose. He can show you the number. Is there minimal investments? No, you could do it with $500 a month if you wanted to, or $6,000 a year. So no, there's no minimum investment. That's the cool thing about it. U.S. printing money. Do you have an opinion on non-U.S. based investment option? Yes. So first thing to know is we're going based on the S&P 500, so they can be basically converted back to, like, in other words, you want to hold assets. When the government's printing money, you want to have assets, whether it's stocks, real estate, all of these are assets. So when the dollar loses value, the value of these things goes up. Yes. And obviously you want to have your portion of your assets in everything else as well, just diversified in things, in other things. Okay. So I think that was pretty much, I answered all the questions. Okay. All right. Good to go. All right, everybody. Thanks for sticking around.
All right, guys. Excellent. Well, thank you.
Thank
Kash.
you
And
so much.
Click on the link to schedule an appointment, to schedule a call with me. We'll go over your options, and we'll take it from there. Kash, we're awesome. Thank you, guys.
All right, everybody.
You're incredible. Thank you so much. We're all so grateful that you're able to come today, and we learned so much valuable information. We're just super appreciative that you could make the time to speak some, knowledge into us today.
Absolutely. Great to meet you, Alexa.
You too.
Bye.
You
Awesome.
too.
Come to our next webinars. Jose, Kash, we have to have you back. So stay tuned. Go to bria.com to see our upcoming events page. We have so many great ones in September, really great for foundational information on wholesaling, rehabbing, what the pandemic is doing. So definitely come to our next webinars. We're going to have a boot camp in September as well. September is jam-packed, and definitely we're going to get in touch with Jose and Kash to bring them back, because I loved it. I know people were definitely praising and offering their support and thanks in the chat. So you guys were excellent. Thank you so much, everybody, for coming today. And we hope you have an excellent time. Great work, guys.
Thank you.
Bye, everybody.
Thank you.
Bye for
Have
now.
a great day, everyone. Thank you so much.